Hey, Erica, thanks so much for joining today.
Hey, thanks for having me on.
Yeah, so you've been doing a ton of interviews about tariffs, and you're actually one of my favorite people talking about tariffs on Twitter. I've learned so much from you. And the first thing that I want to talk about are the tariffs that Trump is proposing, and how does that escalate the current, more targeted tariff strategy that the U.S. currently has in place?
Trump, when he was first in office, imposed several rounds of tariffs. For the most part, they were targeted at China, but then we also had fairly broad tariffs on steel and aluminum and washing machines and solar panels. But the bulk of the actions were with respect to China, and they hit about half of what we import from China, with rates ranging from like 7.5% to 25%. And that's, for the most part, just stayed in place under the Biden administration. They've done a few escalations on goods related to their industrial policy strategies. So think like semiconductors and EV batteries and solar panels. But what Trump is proposing, what he campaigned on, would be a huge escalation. So with respect to China, he talked about just placing a 60% tariff on everything. Right now, like on a weighted average basis, we have like a 10% tariff on everything from China. So this would be like a 50 percentage point increase. And then he also talked about just broadly hitting all U.S. imports of goods with baseline tariffs. The range of 10% to 20% is kind of what seems to be on the table for that. And that would take the trade war tariffs from hitting, roughly like $380 billion worth of imports to hitting all $3 trillion worth of what we import. So just a huge, huge increase in what we're seeing there.
Yeah, and you were the first person that I saw do this math very directly, where when we talk about a tariff income tax swap, what you said is like we have $3 trillion worth of tariffs. How much do we have in income tax? It's like way more than that, right?
Yeah, so the individual income tax raises a little bit more than $2 trillion of revenue every year, and import taxes right now raise about $80 billion worth of customs revenue a year.
Okay. And so could you talk about that tariff income tax swap? And I think I got my numbers confused, but could you talk about like why that math might not add up?
Yeah, so there's a really big gap right now in just what we raise from the income tax versus tariffs. But there's also a really big gap in potential revenue that could be raised. So if we look at like all the income that the individual income tax hits, that adds up to about $15 trillion of adjusted gross income. So that number we all put on our Form 1040 when we file taxes. There's a lot of income to tax. So that tax base is like 15 trillion. Total goods imports are about $3 trillion. And you just can't squeeze $3 trillion of imports hard enough to get more than $2 trillion of tax revenue out of them. It seems like, if we tax this $3 trillion of imports at 70%, on paper, that gets you $2 trillion roughly of tax revenue. But if you tax all imports at 70%, imports are going to drop by a lot. And so your tax base shrinks and you can't actually raise the revenue to fully replace the income tax. Like at most that you could raise, like the revenue maximizing level would be somewhere around $500 billion. There's some complications because when you impose tariffs, that reduces income in the economy. So that reduces income and payroll tax revenues as well. So there's some interactions there that you'd have to account for if you're like actually getting rid of the income tax. But still, you would end up in a big hole if you eliminated the income tax and tried to replace it with tariffs.
Yeah. And also, tariffs cost money. Like they cost money to implement. And a lot of people say that, the companies will play ball. They'll be like, oh, we do want to import into the United States. Like we do want to do business with the United States. Could you talk about like how an average company might feel about a 10% or 20% blanket tariff?
Yeah, I mean, a lot of what we import, like half of what we import, are intermediate inputs. So, like materials that US companies use in their own production processes or their capital goods and equipment. So, it's not consumer facing goods, it's stuff that US businesses need to just operate here in the US. So, if we're imposing a 10, 20% tariff like a blanket tariff plus up to 60% tariffs on all of that from China, that directly increases the cost of doing business here in the US. And that puts US businesses at a competitive disadvantage compared to businesses in other countries that don't face that tax burden on their inputs or their machinery and equipment. So the question that like businesses face when they see this tariff will be like, how do I deal with this increased cost of doing business? Am I able to pass that on to my own consumers? Can I raise my prices? Do I have to eat that cost? Do I have to reduce how much business I do here because the cost has gone up? It's not like tariffs do not equal greater economic growth. They can equal expansion in some sectors that are protected by the tariff. So if a domestic supplier can now sell more at a higher price, they benefit. But anyone downstream of that is facing a higher cost, which reduces, their prospects for success.
Yeah. I've seen estimates that it could cost the average American $3,900 a year from Brendan Duke. How, like, number one, do you think that number is accurate? And then number two, what way would a middle class household feel the impact of a tariff, blanket tariffs?
Yeah, Brendan's numbers are good. They illustrate like this pre-substitution, here's what this problem facing Americans is given a 20% tax on everything and a 60% tax on stuff from China. The actual tax increase that people will face can be different because they might change their behavior. So they might not buy the imported good. Some consumers will get priced out of the market. Some activity will just cease to exist. And so once you take into account like substitution and those tax offsets I mentioned earlier, like the average tax increase will be smaller than that initial amount, but that initial amount illustrates the problem, the cost that we're imposing on consumers and workers and businesses in the US. And then like how that shakes out for, low and middle income households will depend on like how far they turn up the tariff dial and what they do on the tax policy side. But tariffs in general have a regressive distribution. They create a larger burden on lower and middle income households because they consume a greater share of their income than higher income households do. So it will absolutely be a burden on like the median household.
Yeah. And when we talk about tax cuts too, because it seems like this is sort of a dual policy proposal, like, implement these tariffs and hopefully the tariffs will pay for the tax cuts, which will cost, I think, $4 trillion to extend from the Tax Cut and Jobs Act. Could you talk about like how these proposed tax cuts could impact the deficit?
Yeah, so our cost estimate for that is right around $4 trillion. We put it at $4.2 trillion over the 10-year budget window that Congress uses. That's across the individual tax cuts that are expiring. So that's things like the lower rates and wider brackets, the larger standard deduction, the larger child tax credit. All of that is scheduled to sunset after 2025. The larger exemption for the estate tax is scheduled to sunset. And then there's a handful of business provisions that are tightening to deductions for machinery and equipment investment. And then changes have already taken place for research and development expenses and interest expenses. And there's broad interest amongst, lawmakers to reverse those business changes too. So altogether, that would increase the deficit by about $4.2 trillion over the next decade when we're already scheduled to have deficits that are like above $22 trillion. So digging the hole even deeper. Now, if we look at the potential revenue from tariffs, like we have estimated the 20% universal tariff could raise about $3.3 trillion over that same budget window. If you tack on the China tariffs, that gets you up to about $3.8 trillion. So you're still increasing the deficit on net. If we look at all the other tax promises Trump promised on the campaign trail, that could take the deficit impact even higher. And then the way that shakes out for taxpayers, in our estimates, if you take all of Trump's promised tax cuts on the campaign trail with those tariffs, the bottom 40% of taxpayers actually see tax increases. And that's because the tariffs weigh heavier on them than the tax cuts benefit them. If you take out some of those extra tax cut promises that probably wouldn't make their way through Congress, then it would be like at least the bottom half of taxpayers come out worse.
Oh, wow. And that's just because of the imposition of the tariffs and the cost of that?
Yes. Yeah. The distribution of the tariffs creates a larger tax increase on those lower and middle income households than the extension of the tax cuts provides them a benefit.
And when you try to explain that to the average person, do you feel like that argument resonates? Like, do you feel like people are like, oh, this is what a tariff is? Like, do you think the knowledge is shifting? Because I think a lot of people, when they think about tariffs, they're like, oh, the company is going to pay that. Like, there's no pass through rate. Like, I'm not going to be impacted. Do you kind of see the dialogue shifting now that the election is over?
I'm seeing more like reporting, and honestly, there was good reporting on this throughout the campaign too, but there just seems to be this disconnect, especially because of the way that politicians, including Trump, talk about the tariffs. If all you did was tune into a campaign rally and you hear Trump say, like, we're going to tax China and the EU for coming here to do business, and that's going to raise us billions in revenue and it's going to create jobs here. Like, tariffs sound like a great magic wand that fixes all of our problems. But it takes like a few steps of explanation to actually get through that, like, no, tariffs are a tax that are imposed on businesses or people in the US actually buying the good. And then that cost either gets passed on through prices or it eats into business revenues, which means they can hire fewer workers. So it can reduce wages in that way. I think the explanations and the stories that need to be told are being told, but I don't know yet how well that's breaking through.
And when you think about, the economic impact, like obviously a lot of people are going to maybe experience a higher burden because of this. Like, do you sense that this could have a recessionary impact? The tariffs?
That will really depend, on how the Federal Reserve reacts to the taxes. There's a really great paper by Alan Viard, and he walks through like how different tax increases can impact the price level and how the Federal Reserve can respond to that. And this is one of the like really nuanced discussions of the tariff issue. And it'll also depend on whether like these are really abrupt, everything is imposed all at once, or whether it's like country by country, product by product, slowly introduced after investigations. So it depends on the recessionary impact. And that's a question of like what happens in the short term. But what happens in the long term is reduced output and reduced productivity because of the tariffs.
Yeah. And it's been surprising, like seeing how Wall Street has reacted. Bond yields sort of reacted not so positively to the Trump presidency because of the worries of inflation, especially the worries of the inflationary impacts that tariffs could have. Have you been surprised by the reaction from Wall Street from the Trump presidency?
Yeah, I think there's still, maybe it's like people are holding out hope that this was mostly, campaign bluster. This is all negotiation because the end goal is really to just threaten these tariffs and use it to try to get, better trade deals. If the end goal was better trade, more open trade, lower barriers to U.S. exports, that would be good. My feeling is that that's not what's happening here. I think Trump is very serious about imposing more tariffs, maybe even trying to get Congress to actually legislate them. So that makes them, more permanent than just even an executive action. So I think there's just this disconnect between, or this misunderstanding of whether, Trump is serious enough to follow through on these threats. And my sense is that he is. And when we see that like really come to fruition, then we'll see a reaction that makes some more sense.
So you think it's kind of all bark and no bite until, he starts biting, basically?
Yeah, that's what we've even seen. There have been interviews with people like who have Trump's ear on policy, and they're asked about like, what about this universal tariff? And they say, well, no, really, it's a more targeted strategic approach. And then, Trump comes back out and he says, well, now we're going to do 20% universal tariffs when I'm elected. And so there's just this disconnect. And I mean, yeah, the best outcome would be that that it is just talk. But, if we look at the first Trump administration and all the tariffs that were imposed there, and some of Trump's other advisors like Lighthizer and their very serious support of this universal baseline tariff idea, I think that's where things are headed.
Yeah. And when we talk about, some tariffs are okay, right? Like targeted tariffs, the Biden administration, implemented those, but blanket tariffs, that's kind of a different story. Would that be like a good summary of the two?
Yeah, I think any tariff you impose is going to have a trade-off. It's going to come with a cost. And the question is do we think this cost is justified to achieve some goal? And you can make arguments for national security reasons, supply chain redundancy reasons. Those are legitimate arguments to make. But even those arguments, acknowledge yes, tariffs impose a cost, but here's why we think it's worth it. That's separate from what we're seeing on the Trump administration, kind of on both sides. It's blanket tariffs, and it's also they won't impose a cost. They're going to be great for the economy. They're going to grow jobs. They're going to be paid by somebody else. So it's a disconnect on both of those factors.
Yeah. My final question is around just tax reform, and it's super broad, but do you think that there needs to be some form of tax reform in the United States?
Yeah. It's my job to say yeah, but it's my job because I believe there does need to be. The 2017 law made some really important improvements to the tax system and the way we, tax multinational companies. It brought our corporate tax rate in line with the OECD average. But it did a lot of temporary changes too. And that just creates an environment of uncertainty and instability, which isn't good for, financial planning. It isn't good for business investment. And so we can also look at just how complicated the tax system is. I don't think anybody probably enjoys the annual process of filing their tax return and gathering all the paperwork they need. And that burden's even harder for businesses that are engaged in really complex things. And the way that the tax system interacts with that can just be an absolute nightmare. So we all waste billions of hours each year complying with the tax system. And there are international examples of tax systems that just impose much, much lower compliance burdens, which then also makes them a lot easier to administer on the part of the government. So there are absolutely opportunities for simplification, for more neutral treatment of investment, for encouraging more domestic investment. One of the biggest barriers to investment we have in the tax code are long depreciation schedules, which mean companies have to take deductions for, investments that they make today. They expend the cash today, but they don't get to recognize that expense on their tax return until, years later. In the case of investing in a factory, those deductions are stretched out over 39 years, which is just crazy. It really increases the cost of capital. And if you even just shorten that or move to a system of full expensing, that reduces the cost of capital, encourages new investment, and it does so in a way that's neutral. You're not picking an industry for subsidy or for better tax treatment. You're just saying across the board, I don't care who you are. If you build a factory, you get to recognize that cost on your tax return. So lots of opportunities for simplification and better incentives.
Yeah, amazing. Well, thank you so much, Erica. This has been great.
Yeah, thank you.